please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
It's time to invite our market master for the morning. Bharat Iyer, Head of India Equity Research at JP Morgan, joins us in the studio. Morning, Bharat. Always a pleasure having you, and doubly important because you're coming at a crucial moment. Would you agree with what Udayan was telling us towards the end of the conversation, that the earnings picture is not that bright as we thought on first glance?
Well, Lata, I would agree with that in the sense that I think street expectations are still frothy. If you see FY18 now, I think the street is still expecting 14-15% earnings growth. For the first half, we were flat, and which means that the run rate expected of the second half is more than 25 to 30%. Good that the third quarter reporting season has been so far. I don't think we're going to do 25 to 30% in the second quarter, or in the third quarter or the fourth quarter. And likewise for next year, I think the street is at 20 to 23%. I think 14-15% seems more like par for the course rather than 20 to 23%.
Yeah. And this year, what would your number be?
This year, I think we'll be happy if we get 8 to 10%.
Okay.
Bharat, good morning. Of course, so a lot of this is global in nature. Are you sensing first signs of trouble in the paradise? I mean, the equity paradise?
I think, Anuj, what's happening is that markets are beginning to price in a higher cost of capital. And this is the beginning. I think we still have a long way to go. But yes, I mean, these are the first early signs.
That would be a big negative for the broader market because, we have seen a big part of this rally was interest rate driven rally as well.
You're right, Anuj, in the sense that, see, I don't think this is the end of the bull market. Yeah. But I think what's happening is that we are getting into the mature phase of the bull market. And that means that, we'll have a lot of volatility which comes in. And I guess, the other takeaway that at least I, make out of this is that valuations have perhaps peaked. So, I think earnings growth will have to do the tough job from here onwards.
But as a global market watcher, don't bull markets hinge on growth? And we're getting good growth, right? I mean, Chinese PMI has improved. Even in the US, we've seen wage growth pick up after so long. Isn't that a positive sign? And don't you think that would be the next leg of the bull market?
It is positive, Sonia, which is the reason, as I said, I don't think this is the end of the bull market. But, for the last 6 months, we had this Goldilocks syndrome where the markets were being driven by two engines. Valuations because of easy monetary policy on one hand and a pickup in growth. I guess one engine now starts tailing off a bit because of the higher cost of capital, investors starting to impute a higher cost of capital. So the tough work will have to be done by earnings. It does not mean markets have peaked, but yes, I mean one engine will have to work hard now.
No, is the rise in the cost of capital higher than you anticipated? And therefore, would you want to trim your earnings expectations for this year or the next?
I think earnings expectations globally, if you ask me, are okay. Because we've had this trajectory where, earnings have been picking up and economic growth, if any, has been surprising and has have corporate earnings. But on the cost of capital front, yes, I think, markets are getting a little jolted out of complacency. Because if you see, I mean, if I look at our own house view, we were expecting 4 rate hikes this year by the US Fed, whereas the market for a long time was perhaps pricing in only 2. And I guess, we're seeing a little bit of a shift there in that paradigm.
Yeah.
Okay, by the way, there's some bit of recovery in the market, and not entirely unexpected. 10,550 was supposed to be big support. IT is starting to do well, and not just large cap IT, mid cap IT. Take a look at a stock like NIIT Tech, for example. That's the one where at least there's some semblance of buying. That's the Nifty IT, which is about up 1/3 of 1%. But overall, there's still clearly pain in the market. 1:19 advanced decline is what we have. Could this be a bit of a safe haven for now?
I would think so. Near term, it's not a bad space to be in because, on the one hand, you perhaps have the rupee depreciating a bit, which is always good from a sentiment point of view. You had meaningful supply taken out of this sector in the last 3 or 4 months because most of the large caps have done buybacks. And, the global growth environment is still okay. So I don't think we should get very carried away on the growth front. Yeah. But that said, in terms of the relative underperformance we saw last year, perhaps a little bit of mean reversion.
Is this a buying opportunity for long-term investors? And if yes, what are the pockets that you will be looking at? Maybe not now, but over the next few weeks. I
think, as I said, I don't think the bull market's ended yet. So I'd look at this as a bull market correction. Okay. And in that sense, yes, I think, it is a buying opportunity. I think, 2 or 3 pockets look very interesting. I think, if you look at financials with a very solid liability franchise, if they tend to get sold out in this sell down, I think, that's an interesting place to look at, particularly if they have a very good financial services franchise. Segments that cater to the government's core infrastructure priorities, areas like cement, tractors, construction equipment, select capital goods companies. I think they should all do well. I think the budget was reasonably good to these sectors in terms of outlays. And I think, a theme like urban consumption still has a long way to play out in India. You have the demographic advantage. You have so many people still living in villages. And, agriculture is clearly not doing too much, so they have to keep moving in. So I think the long-term themes are still good. But yes, you have to be a little cognizant of valuations given what's happening to the cost of capital.
Okay. Would you be more global facing than domestic facing?
Near term, I think, again, within global facing, Lata, will have to, make a little bit of a distinction, because what could happen is, if this cost of capital paradigm keeps going on and you see the dollar bouncing back meaningfully, that could mean bad news for the resources complex. So let's see how it pans out. I mean, it's still very early days. So one will perhaps have to be a little selective in terms of what one does.
Okay. What is your take on the budget itself? Is there a worry that fiscal deficit is more than you all anticipated, or the MSP issue could lead to more CPI inflation? And therefore, what's the take on the domestic cost of capital?
See, I think, we had a fairly pragmatic budget. I think, I quite, like the assumptions in terms of nominal GDP growth, in terms of the expenditure part, the fact that consolidation was being driven more by cutting down on revenue expenditure rather than capital expenditure. I think, but like many other people, we do worry about is the tax collections budgeted on the GST front. And honestly, I don't understand too much of it. So it's something which remains a bit of a black box. So we'll have to see what happens. And added to this is the worry on oil. So I guess, but to be fair, I mean, it's not just the budget, right? I mean, the bond markets have been pricing in these stresses for some time now, nearly 6 months. And I guess, they've priced it in fairly at this point in time. So, I don't see any hiccups from these levels. But that said, is the higher cost of capital a worry? It definitely is.
Okay. You spoke about some of these domestic segments like cement, tractors, etc. What about, more rural-focused spaces like two-wheelers, for example? Is that a space you like? Because we're seeing a lot of big moves in names like Bajaj Auto, etc.
I think that's a space where, we're neutralish at this point in time, basically because of two reasons. One is, valuations have really surged in that space. And the other issue is, this is a segment that has reasonable penetration levels. So, it's good for an 8 to 10% kind of volume growth. And, if that's well priced in, well and good, otherwise, you don't really want to chase those stocks at these levels.
Okay. We almost forgotten to ask you, is long-term capital gains negative at all? Your take would...
Well, I'll answer that question in two parts, really. I think, first and foremost, is it negative for an investor? It definitely is. Let's not forget that, till yesterday, if I made 100, or day before yesterday, if I made 100 rupees in gains, I walked away with 100 rupees. Today, I walk away with 90 rupees. So, do the markets have to derate? Everything else being the same? Yes, I think they should. But that said, I mean, from a policy perspective, do I look at it as a negative? Not necessarily. For 2 or 3 reasons. One is, if you look at it, most countries in the world, whether it be in the developed markets or be it in terms of emerging markets, do have long-term capital gains tax, and most of them in the 15 to 20% range. So we're still better off. That's one issue. The second issue is, we perhaps had this very liberal structure at a point in time when we needed to encourage money coming into equities. The foreigners saw India more as a cyclical market than a structural market. Local savings were not coming in. Now that has changed. I mean, foreigners see us more as a structural bet rather than as a cyclical bet, and domestic savings is coming in. And to be fair to the government, I think they let us know about their ideological stance as early as December 2015. So, I mean, we can't complain.
Okay. Just on the issue that, again, we discussed with Udayan, and you probably heard, the cost of capital is higher and there is a tax on equities. Will you see this domestic liquidity that you spoke about flowing into equities getting disturbed now and more going to debt?
Partially disturbed over the near term for 2 reasons. One is, let's face it, the relative attraction of debt versus equity has improved meaningfully in the last 6 months. One, with yields going up. And secondly, we've had this change in taxation. But that said, Lata, if you ask me, this surge in domestic liquidity into equity markets that we've been seeing over the last 3 years, I think has 2 components to it. There is a structural component to it, as reflected in money coming in through SIPs or the provident funds investing, etc., which still I think has a long way to go. And there was the cyclical component, real estate not looking good, gold not looking great, done with rate cuts by the RBI, so it thought equity was the best part. I think the latter part has a chance of swinging the other way. The former part, the structural part, I think still continues.
Okay. All right, Bharat, thank you for stopping by and speaking with us, and have a great week.
Just squeeze in one more. What do you think is, I mean, how much bad can it get for the Nifty? What are your own in-house technical experts telling you?
Well, I mean, we don't...
Or even what's your own guess? I mean, are we like kind of already in buy zone?
I guess in this correction, Lata, I think the Nifty bottoms out somewhere between 10,000 and 10,300. I still think that, the next month or so could be a fair bit challenging, both for global and local reasons. But I think in this round, I think that's perhaps a good bottom to start with. And yeah, we'll see.
Okay, and that's of course also the